What's going on, everybody? I want to start off with saying thanks. Thanks for watching my YouTube. I appreciate it. Getting a ton of views, thousands of views, which is pretty awesome. And yeah, so I want to start with thank you. But today, I want to talk about something that keeps coming up. People keep asking about it. People are watching a lot of the old videos, and it's happening more and more and more. I'm doing a lot of these loans, but it's talking about ground up construction, right? So I want to talk about the different types of ground up construction that are out there, some of the variables that are going to be in there as well. And I might do a detailed video when it comes specifically to investor-based ground up construction. So let's just talk about what it was, right? So back in the day, and I think I've mentioned this before, back in the day, it used to be that your grandmammy or pappy or whatever else used to be able to get some land, right? It didn't cost much, like a nickel. It cost like a nickel, and you could get some land, and you could just build on it. You just build a house, right? Of course, that changes. I don't want to turn this into a weird video where I start going into what I think changed, but the reality is things changed when you start bringing in regulation, when you start, and regulation sometimes to protect, sometimes to for safety, sometimes for money. Just is what it is, right? But regulation comes in, and so, but it's still at the core of it. From forever ago to now, it's the same thing. You come up on land and you build a dream home, right? You build your house. So nowadays, there's a few different ways to do that. There's ways of building your dream home on a stick build. So what does that basically mean? Well, if you go into just about any neighborhood where there's a row of houses, those are permanently affixed on foundation, poured foundation. They actually start taking sticks and building it up, right? So stick built house. There's manufactured homes. So I'm sure you've seen those. Manufactured homes are typically going to be sitting on piers. Sometimes they can be put on foundation. Or you can have what's called a pit set, where they actually dig out the ground and they lower it into where it's flush with the ground. So you could do a manufactured home. You could do modulars. You could do barn dominiums. You could do, I see some of these container homes, which are wild looking, right? Container homes. Long story short, you got to have some land and you got to build on it in order to build your dream home. And all of that takes money. Some people, they have plenty of money, so they just pay cash. And honestly, if you have the cash, in my opinion, unless you're an investor, if you're an investor and you're looking to build ground up construction with the intent to sell or intent to rent, well, there's investor-based products specifically for that are significantly cheaper than a traditional means, which a lot of, builders and investors do. They still use a traditional means. We'll talk about that is, and a lot cheaper than hard money. A lot of investors use hard money actually to do a lot of spec building in different phases of the build. And I'm here to tell you there's better options for that too. So let's talk about, you got land, right? That's a factor. And then you got to build something or some type of thing. Each one of those things all have different types of loans that are associated to it. So let's talk about the old school way of doing things. Then we'll talk about the variables after. The old school way of doing it is you would buy the land, getting a land loan. I always tell people land loans it's considered a high risk loan. Okay, why? And I talk to so many people. I probably qualify 60 to 90 people a month. And I think I'm so used to hearing the same thing from every conversation that it makes it really easy for me to just kind of know what questions come up. So why? Why is it this? Why is it that? So let's talk about what the terms are typically on land. And when I say typically, I'm not even going to talk about me as far as what I do with loans. I'm going to talk about typical in general, because wherever you are, if the goal is that if you watch this video, you're getting education. If you call me because you want to explore these loans, fantastic. If you want to call other people, fantastic. I kind of just do this. I think I have over 700 videos. And I just kind of do it because I enjoy putting out the information. So typically, when it comes to a land loan, you're looking at paying anywhere from 25% all the way up to 50% cash down. 25% to 50% cash down. The interest rate typically is always going to be higher than the going rate. What is the going rate? If you jump on the Google box machine, right, the internet, you should be able to find what is called the going rate. So what is going rate? It means you have like an 800 bazillion credit score, perfect credit, perfect income, perfect debt. And it's going to say, okay, well, if you got a conventional loan or an FHA loan or a VA loan, conventional loan, your going rate today is, 5%. So that would be the going rate if everything is perfect. So if the going rate is 5%, let's just say, we're just throwing it out there, you can expect a land loan. I try to tell people the cheapest you'll see it is 1 percentage point over the going rate, but typically it's going to be 2 to 3 percentage points over the going rate. On top of that, most land loans are going to be on a 20-year note, not a 30-year note. So let's think about that. The way I explain this sometimes when people are confused about it is almost everybody has bought a car at one point or time. And there's different loan terms on how long you can have that loan. The longer you stretch out the loan, typically, the cheaper the monthly payments. So if I owe $100 and I can span that out, and we'll just figure it out. So I can span that out over 5 days, 20, 40, 50, 60, 70, 80, 90, 100. So in 5 days, I pay $20 a day for $100. But if I dropped it down to 2 days instead of 5 days, then I pay $50 each day for 2 days. So when you lose 10 years on a 30-year loan, the monthly payments, you got to make up those 10 years somewhere. Those monthly payments are going to be more for the first 20, the front end of that, the 20 years that are on that note. So that's what you're typically going to see with a land loan. So the question is why? Well, land loans are considered a higher risk loan. Well, I don't think they are. Well, it doesn't matter what you think. It comes down to what does the bank think? Ultimately, the bank, and I've had this conversation with people too. At the end of the day, here's the situation. You don't have the money on hand. If you have the cash on hand, you don't have to even watch this video. You can do whatever you want. But if you need to borrow somebody else's money in order to do what you want to do, then you have to borrow the money on their terms. The bank does enough business. So I always tell people the bank only cares about two things. They care about protecting their asset and making a profit. Part of protecting the asset is, are you credit worthy, right? Have you borrowed money and given that money back and paid it on time and then gave a profit on top of it? That's part of being credit worthy. Do you have some type of work history? And it's less about the work history and more about income history. So I've had a job for 2 years or more, and I can project by looking at the 2 years past history or more that you're going to continue to work for however many years in the future at or more of the present income. Therefore, you can cover the debt. On top of that, we're going to look at what is your total debt with what you're looking to purchase. Okay, well, I make $10,000 a month, but $8,000 at $10,000 goes towards buying. I have some really cool sports cars, right? I'm just gonna throw it out there. So you don't make $10,000 a month. You really only have $2,000 a month in actual available cash. It's not a lot, and I have that happen quite a bit. Well, I make a ton of money. You do, but you have a ton of debt. Therefore, you really don't have a lot of income. Had a guy who makes $15,000 a month, but he can only show a total of $473.47 in monthly income. Wow. Now that's a whole different discussion if we start getting into that, but we're not talking about that. So what is the typical for land? Land is considered a higher risk loan. Therefore, the interest rate is going to be higher. It's going to be a shorter term, and they want more money up front. What I've traditionally seen is if you find a lender that will give you a land loan with a low down payment, you're going to have a higher interest rate. I found that the lenders that give you a higher down payment, they'll give you a lower interest rate, and then somebody in between. Somebody in between usually looks like about 35% cash down. You get a fair down payment with a fair interest rate. And that's, again, what I've seen. So then, step 2, you get a land loan, keeping in mind there's closing costs associated to that land loan. Next step is you're going to have to get a construction loan. Same thing, construction loans are typically considered a higher risk loan. So most of the time you're going to have to put 20% down, and the interest rates usually start at about 8 to 10%. And you have I've seen them anywhere from 18 months to 2 years on a construction loan. And that is another loan with another set of closing costs. So now let's talk about different types of homes. I said that you can get a construction loan on all sorts of different types of homes. That's true. It's very difficult to get construction loans on manufactured homes. It is. It gets harder and harder. There's a couple really great banks that do it. We're brokered with a few different ones that do them, but it's pretty difficult. But stick-built homes, you could pretty much get those old days. Barn dominium, same thing. A little difficult, but they're out there as well. So once you get the construction loan, so we got a land loan, so we own the land. We got a construction loan, so we could build on the land. Once the construction is complete, then you have to refinance those two loans into one loan. That loan is going to probably, more than likely, be an FHA, a VA, or a conventional loan, sometimes USDA loan. USDA, I probably should do some videos on USDA loan. There's so many myths about those things. But typically you're going to do that with another set of closing costs plus down payment that's associated to that loan type. So that's the old school way of doing it. As you probably heard, there's a lot of bleeding when it comes to money. A lot of money going out. It just is what it is, a lot of down payments. What are ways of getting around that? Well, there's a different way, and that's the one-time closed construction loan. I do quite a few of those. Our team, I should say, the KDM team. The one-time closed construction loan is really freaking cool. So there's pros and cons to both. So let's talk about the old school way of doing it. What are the cons? It's just a ton of freaking money. You got to make sure you have a lot of money on hand, money out of pocket. You're going to have to come out of pocket quite a bit. Honestly, land, 35%. So let's say you find a piece of land for $100,000, 35%, $35,000 needs to be there. And then you got to start making payments once you close, plus closing costs. I didn't even mention, you still got closing costs on that. Then 20% on the construction. Construction, let's say it's going to be $300,000, 20%, 20, 40, 60. Okay, well, there's more going right out right there. Plus, you got to start making payments, plus closing costs. So a lot of people like doing the one-time closed construction loan. I do a lot of one-time closed construction loans, or we have been with the VA loan, which is sweet, right? So with a one-time closed construction loan, we're able to basically we're going to buy the land. We're going to borrow money to buy the land and pay for the construction with one loan. And instead of doing a land loan, a construction loan, refinance those two into a VA, FHA, or conventional, we're going to start with one loan that's a VA, FHA, or conventional. We're going to start with the end loan. So I'm going to use VA as an example. So with a VA loan, we're going to, client finds a piece of land. This is the land that I want. It costs, we'll use the same scenario, $100,000. Okay. And then the construction is going to be let's just say four, so we round it off, right? 3, 4, so it's $500,000. So it's $500,000 total, land plus construction. $500,000. We're going to do a VA loan for $500,000 with $0 down, $0 out of pocket for the down payment. Are there still closing costs? Yes, there's still closing costs. I think that's a huge myth with the VA loan. A lot of people say, well, the VA loan's free. There's closing costs. Well, why are you making me pay the closing costs? Lender, I'm not making you pay the closing costs. You're hiring people to do specific tasks for you or specific jobs for you, and they don't work for free. Title doesn't work for free. Escrow doesn't work for free. The government doesn't work for free. That's for sure. If you're an adult, the government doesn't work for free. They tax us. Well, guess what? You got to pay those taxes. You're typically going to have to pay homeowners insurance up front. There's a certain amount that's going to be held, anywhere from 6 months. I've seen it up to a year. But there's fees. You're going to have to get the appraisal. That's a fee. You're going to have to get your credit ran. That's a fee. That's closing costs. A lot of people think the lender makes you pay these these are just stupid fees. No, you could choose not to do certain things, but then you aren't getting a home. Do you do title? Do you do escrow? Are you going to do any of this? No, you're not. Then you got to pay somebody. And they don't work for free. Therefore, there are still going to be closing costs. So one-time closed construction loan. Let's, again, using the VA, $0 down to buy the land. So we'll still close that. We'll get it done. I typically tell people, and they're like, well, can you get done in 21 days? No. Look, if you walk down the street and you see a house in a neighborhood and there's a ton of comps and it's in great shape, You could do a VA loan on that house, yeah, in 21 days or less, no problem. But this is not it. And it always blows my mind how people underestimate how much time it takes to build a ground up construction home. They're like, well, why can't we close in 30 days? Because it's a ground up construction loan. It's going to take some time. There's a lot of moving pieces. So we got to make sure that we get the land checked. We got to make sure the builder agrees. We got to get all the builder information. We got to make sure we have the draw schedules. There's a ton of stuff that's going to be involved for the lender to get it done, right? The MLO, somebody like me. But there's also a lot of stuff that the client needs to do and also the builder needs to do. We got to vet the builder. There's a lot of stuff that's going to be there. But ultimately, look at it like this. So let's say it's 45 days or less or 60 days or less. Whenever we have that closing date, the land is purchased, paid off, free and clear, goes to the seller. That money goes. Then a side pot of money, let's say the $400,000 for construction, that is set into an escrow account. And there is a draw schedule that's scheduled with your builder. So as they complete specific tasks, then they can request to draw more money in order to get to the finish line on that construction. But ultimately you're done. Zero down, pay the closing costs, $500,000 on a VA loan, still no MI, no mortgage insurance, right? Low freaking interest rate because it's a VA loan. And you don't start making payments on that home until you move in. That's the kicker. That's the kicker. So once the construction is complete and you move in, then you start making payments on your VA loan. And it's just a VA loan. Now, is there a lot into that? Yeah, of course. But that's where you sit down with somebody that does and specializes in one-time closed construction loans, and you go deeper into the details. Right now, I just want to do a video. We're already 17 minutes deep on this thing. But I want to go into the video and just kind of get into it, give you some information, right? So if you're doing some research, you can look. So that's, okay, what are the cons of the one-time closed construction loan? Time is against you. In most states, it's not a factor. So example, one out in Virginia, $1.7 million ground up construction from raw land takes 9 months to build. 9 months. Turns out with a one-time closed construction loan, you have 12 months to complete the construction. Now, Virginia, 9 months to build a $1.7 million house. If you came to California and built a $1.7 million house, how long do you think it would take? I will tell you, partner, 2 years or more. The odds are good more. Longer than 2 years, more than likely. Why? Well, some states make it easier to build. Straight up. And I know in California specific, there's been a lot of discussions and there's always these meetings. I used to go to them and I just sort of stopped going because it just gets frustrating because I work with a lot of builders and construction and, people. But they always have these meetings. San Diego County, they have these meetings. LA County, they have these meetings where a government official wants to get together with the local public to discuss the housing crisis. We're in a crisis, and it's always because of the greedy builders. It's the greedy builders. Okay, here's the reality. View it almost like you're building your own dream home. The goal is that you want to keep it at as cheap as you can on the budget, okay? What gives you the limitations on that budget? Cost of materials, cost of crews to build, but the big one is also going to be utilities, fees, permitting, time. Time costs money, right? So when I have to submit plans and it takes a day, that's great. If I have to submit plans and it takes 6 months, that's not great because you're borrowing money. Every time you borrow money, you're going to have to pay interest on that money somewhere. There's always, you're still going to pay. You're paying. So it costs you money. Before you even start swinging a hammer in a lot of ways in California, you are 6, 7, 8 months into it. And this is if it's something simple like a manufactured home. They drive it out, they pop it on a lot, right? You're 6, 7, 8 months into it, just dealing with the local governments and feeding them money, paying them money. Water meter, $20,000 plus. However, if you go to other states, they streamline the process because they see housing as a need. So if there is a lot of bureaucracy in your state. You gotta take into account that 12-month mark. 12 months or less for a one-time closed construction loan. If it can't be done in 12 months or less, the one-time closed construction loan probably isn't for you. And almost always, actually, I'm just going to say it always, it's because of local governments, and if they will allow you to get it done quickly or not. So you got to take that into account. To me, that is the only con to the one-time closed construction loan. Now let's talk about investor-based loans for ground-up construction. There are a ton. A lot of builders and a lot of investors will do traditional, like I said, the old school way of doing it. They'll do that. But there's a lot of, like I'm brokered with a couple banks that really specialize in ground-up construction for investors. And it's a lot like the one-time closed construction loan. Actually, what's funny, I was sitting here looking at some stuff this morning. Is it here? Hold on one second. Let me pull it up because I can actually like read off some of these things. I'm prepping a write-up for a client. Now the interest rates. Okay, so let's say loan to cost, right? So if you're an investor and you watch this, loan to cost, up to 85%, up to 75% after repair value. Typical origination fees is about 1.5%, all the way up to 2%. But I would tell you the loan. So let's just talk about loan terms typically for ground up construction for an investor. And it's crazy that I already had this up. Okay, so I'll just read it off to you real quick. Okay, so 50,000 to 20 million, 50,000 to 20 million. Typically the term is 18 months, looking at 18 months, and the interest rate. So this is, think about it. I told you the interest rates are usually high and you're bleeding twice for if the old school way of doing it, right? Interest rates are typically gonna be about 9.5 to 10.75. And this is with stick build home type stuff. Manufactured homes have a completely different product for actually, I think I'm the only person that I know of that's able to do ground up construction for investors to build to sell or build to rent for manufactured homes. But yeah, I mean, this is another one. You have to have completed 3 construction projects. So you have to have a portfolio of success in the past. If you're an investor, definitely really, really important. But you can sell it early. You can refi it into a rental or whatever. But so let's do like a quick scenario. Total cost to build is $400,000. Land permits, build everything. We can fund $340,000 of that total. So wrap your head around that. 340 of 400,000, 40, 50, 60, 70, 80, 90, 100. So you're out of pocket 60,000, and we'll fund the rest of it. So you can actually do the construction and then sell it. And ideally, if you're doing that, so if you build it for 400,000, ideally you're selling for 450, 500, 550. So you're getting that profit back. And for $60,000 out of pocket, when you look at that ROI, it's a pretty great ROI. But yeah, there's definitely some terms. And if you're an investor and you want to deep dive into it, hit me up. I can put together a proposal for whatever you're looking for and we can discuss it. But anyways, I wanted to do a quick video. It's not quick. I mean, I'm 23 minutes into this. It's just, so here's the reason why I do a lot of these videos. I run into so many different clients that ask questions, or real estate agents will reach out to me, or investors will reach out to me and like, hey, what about this? And I go, I got you. I'm going to send you a quick video. And I do it by text. I'll send them this video, and they can sit down for 23 minutes and 54 seconds and kind of watch me just run my mouth, and it preps them for our conversations. So that way, when we get on, they have a working knowledge, or if you call me, you have a working knowledge. So when we get on, we can talk specifically about your project and how to get it done, as opposed to me having to spend 20 minutes spinning you up. Then we can talk about your project. So that's why I do these videos. I've been doing them for years and I enjoy doing it. But that's all I got today. Thank you so much for watching. I appreciate it. And if you need anything from me, please reach out. You can look in all the comments and stuff below, or write up the description. I put in my phone number. I had somebody, they're like, oh, this is a bot. My phone numbers, you can call me. People call me from all over the country from watching these videos. Just call me. My phone number's there. Email me if you want. I don't check email that well. I'm not really good at email. So if I don't reply right away, you're like, oh, Kris is a prick. He didn't reply to my email. Well, I warned you. I told you I probably wouldn't see it. Call me or text me. You can find me on social media. You can hit me up on Facebook. You can hit me up on Instagram. Of course, YouTube, LinkedIn, kind of anywhere. Considering, keep in mind, I'm a Generation X guy, so you probably won't see me doing any TikTok dance videos. It's just not my thing. Call me. All right, appreciate it. Have a good one. If I can turn this off.